Dear students, my name is Manish Kumar Singh. Today we are going to discuss very most important in corporate finance, financial break-even point. Financial break-even point is such a point where EPS will be zero. It means EBIT will be equal to payment of all fixed charges, all fixed obligation in terms of interest, in terms of preference dividend, and after deducting interest and preference dividend from the EBIT, there will be nothing remaining for distribution among shareholders. So we will call that financial break-even point is the point where EPS will be zero. Financial break-even point, the financial break-even point is such a level of EBIT at which only the fixed financial charge of firm are covered and consequently EPS is zero. If the EBIT reduces below the financial break-even level, EPS will be negative. Financial break-even level of EBIT may be calculated as follows. If the firm has employed debt only and there are no preference shares in the capital mix, the financial break-even EBIT level is equal to interest charges. If the firm has employed debt as well as preference share in capital, then its financial break-even EBIT will be determined not only by the interest charges one, but also the fixed preference dividend. Formula will be as follows. In financial break-even EBIT equal to interest charges plus preference dividend divided by 1 minus tax rate. Let us see with a numerical examination for clarification of the concept of financial break-even point. XYZ is a XYZ firm is having interest liability of 20,000 and preference dividend of 36,000 given the tax rate at the rate of 30% and corporate dividend tax rate is given 20%. Find out the financial break-even level and verify the result. Calculation of EBIT financial break-even point, interest charges plus preference dividend plus corporate dividend tax divided by 1 minus tax rate. In this question, interest charges is 20,000. In preference dividend given 36,000 and preference dividend tax rate is given in this question at the rate of 20%. Then we will calculate preference dividend tax at the rate on the basis of 36,000 preference dividend, and preference dividend tax will be 7,200, and we will add both 36,000 plus 7,200 and add 20,000 interest charges and divided by 1 minus tax rate, 1 minus 0.3 and 30%, we will get 81,714 rupees. Total EBIT in this situation 81,714 rupees. We verify the result after deducting all expenses. Interest charges 20,000 less corporate tax 18,514. How 18,540 have come? We will see 18,740 after deducting 20,000 interest. We have only 61,740, and on the basis of 61,740 at the rate of 30% interest, 30% tax rate, corporate tax will be 18,514. We will less preference dividend 36,000. We will less dividend tax 7,200, and after deducting all fixed charges, corporate tax, preference dividends, and preference dividend tax, interest, EBIT will be zero, and there will be no EBIT, no profit is remaining in the firm or in the company for distribution of the shareholders, for distribution among equity shareholders. In this scenario, we will call this level of EBIT is called financial break-even point. This is the important question, important concept, and we have clarified this important concept in corporate finance with numerical examples. And thank you for your patience listening. We will meet in next session with the next topic. Thank you so much.